let's go over closings because I see a lot of confusion out there in the questions I'm getting. This is problem 3.3. That is the homework problem for chapter 3. And I think everybody has the closings fairly well down, or the adjusting fairly well down. You made the adjustments from the scenarios given. You've adjusted the trial balance for those adjustments. You've made general journal entries. You've made journal entries over here that reflect this. In theory, once these entries are made, they show up in the general ledger, which is this right here. So you've adjusted to the adjusted trial balance. You've pulled off the balance sheet accounts here, and you've pulled off your income statement accounts here. You've totaled these, both of these. You've come up with a net income of $49,600. It's correct because when you add up the balance and add that to the credit side, you're balanced. So your net income is $49,600. You've got an income statement, you have a balance sheet. Your problem is you don't have this net income in any account here, right? It's just kind of out there. It's not in an account yet. So then we go to the financials, and we do the income statement. We come up with that net income. We do a statement of owner's equity. We had a beginning equity of $90,000. We had no investments. We had this net income that gets transferred to here. And we had withdrawals of $50,000. And we ended up with an ending equity of $89,600. Now, there's not been an entry to transfer either the net income or the withdrawals or dividends into the equity account. This is just being done in the financial statements right now. And we have to eventually get these two amounts into the capital account or the retained earnings. So bear that in mind. At this point, this is just on a piece of paper. It has not been put into the general ledger, and that's our next step. From this statement, we then can create the balance sheet, which everybody pulled off very well. We've got the ending equity that goes here, and then that balances everything. The only problem, some forgot about the accumulated depreciation that has to be subtracted from the asset that it's tied to. So that is a net on there. So you've probably got this far and you're good, but then you hit this wall. And I think what we missed in the process is, one, I did not have the account up to date. I wanted you to concentrate on what the journal entry should be without knowing what was in the account. I mean, you should be able to know what's in the account from this right here. When I say you empty out or you make the balances zero, this would be the amount that you would make the zero, that would make the account zero. So you just kind of reverse those. But now, this is what you have. You have fees earned that has a credit balance, and you have salaries that have a debit balance. These, all of the revenues and all the salaries need to be at zero, along with the draw, so that you can start a new period, accounting period. So to do that, there are 4 entries that you have to make. First, you have to close the revenues. And we had 2 revenue streams. One was tuitions and one was training. And I combined them in one account. So I need to get rid of these. So I would have to debit them. And here's the entry. So if I debit both of those, and 45,000, the balance becomes zero. I have to have a corresponding credit for that debit, and that goes to the income summary, and it's going to be credited. Now, it now has a balance of $176,400. Remember that income summary is not a permanent account. It's probably there for however long it takes to do these entries. So that takes care of the first closing. The second closing entry are the expenses. The expenses have a debit balance, so they all have to be credited. So you set up the journal entry by crediting all of the expenses, adding that up, and then debiting income summary. Now this all added up to $126,800. But let me show you, if you credit each one of these, the balance becomes 0. And that's what you want. So you can have a clean account to start keeping track of expenses in the next financial period, or accounting period, however you want to look at that. So you'll notice as I am crediting each one of these, all the balances are becoming 0. The only account that still has a balance that you'll have to get rid of is the draw. Okay, so I've credited those. I'm going to debit this one for $26,800. Now I have a balance of $49,600. What is that number? What are revenues minus expenses? That's your net income, right? Net income was added to the capital account. So now I have to close that income summary. I remember I want it to be 0. We're going to debit this account for $49,600. That gets that to 0. I'm going to credit the equity account, and that increases the equity account. Now, there was one more thing that we had to do, right? We got to close the draw. What did we do with the draw or the dividends? We subtracted it from capital. So this needs to be 0, and that's our credit. That's at 0. Our debit is the capital account. Bingo. Now the general ledger agrees with what the financial statements say it should. And that's why we do the closing, so we can get, number 1, all of those accounts closed, but number 2, so that we can get the financials and the general ledger in agreement, so we can start the next accounting period off with a clean slate. I hope this has helped. Please email me and let me know if there's any other questions you have. Watch this again and again and again. Thank you.